Hey guys, today we are continuing our series where we hear Buffett give his take on investing with a small capital. It's always great to know where super investors are investing, but believe it or not, these investors have a heck of a lot of money compared to you and me. So sometimes it's also good to hear how they would invest if they didn't have billions of dollars. So let's hear it from Buffett, and then I have a surprise for you guys later in the video.
If I were working with a very small sum, and you should all hope I'm not, if I were working with a very small sum, I would be doing almost entirely different things than I do. I mean, your universe expands. I mean, if you're looking, there's thousands and thousands and thousands of times as many options to think about if you're investing $10,000 than if you're investing $100 billion. And obviously, if you have that many, you got all the options you got with $100 billion, except buying entire businesses, and you've got all of these other options. So you can earn very high returns with very small amounts of money, and it will always be such. I don't mean that everybody can do it, but if you know something about values and investments, you will find opportunities with small sums, and it will not be with the portfolio that Berkshire itself owns. We cannot earn phenomenal returns putting $3 billion, $4 billion, $5 billion in a stock. It won't work that way. It won't even come close to working that way. But if Charlie or I were in a position of working with $1 million or $500,000 or $2 million, we would find little things here and there, and it wouldn't always be stocks, where we would earn very high returns on capital.
If Charlie and I were starting all over again and we were in this, Charlie would say we shouldn't be doing this, but if we were to succumb to Satan and engage in same kind of activity, we would, I think, be doing something very similarly. If we were investing in securities, we would look around the world and we would look at a Korea, and Charlie says you can't find 20 of them, but you don't have to find 20 of them. You only have to find one, really. You do not have to have tons of good ideas in this business. You just have a good idea that's worth a ton occasionally. And in securities, we would be doing the same thing, which would probably mean smaller stocks. It would mean smaller stocks because we would find things that could have an impact on a small portfolio that will have no impact on a portfolio the size of Berkshire. If we were trying to buy businesses, we'd have a tough time. We would have no reputation, so people would not be coming to us. We'd be too small a player if you're talking about $1 million. So we would not have much success, I don't think, with small amounts buying businesses. Charlie started out, in real estate development because it took very, very little capital. And you could magnify brain power and energy, or I should say brain power and energy could magnify small amounts of capital in a huge way that was not true in securities. My natural inclination was to look at securities and just kind of do it one foot in front of the other over time. But the basic principles wouldn't be different. I think if I'd been running a partnership a couple of years ago with a small amount of money, I think I'd have probably been 100% in Korea. And, I would be looking around for something that was very mispriced and that I understood. And every now and then that's going to happen. Charlie?
Well, I agree with that. The concept that you're likely to find just one thing where it'll make 20% per annum and you just sit back for the next 40 years, that tends to be dreamland. And in the real world, you have to find something that you can understand that's the best you have available. And once you found the best thing, then you measure everything against that because it's your opportunity cost. That's the way small sums of money should be invested. And the trick, of course, is getting enough expertise that your opportunity cost, meaning your default option, which is still pretty good, is very high. And so the game hasn't changed at all in terms of its basic arithmetic. And that's why modern portfolio theory is so asinine.
It really is, folks.
Yeah. When Warren said he would have been all in one country, that's pretty close to right. He wouldn't have quite done that when he had the partnership, but he would have been way more concentrated than is conventional if you listen to modern portfolio theory. Most people aren't going to find thousands of things that are equally good. They're going to find a few things where one or two of them are way better than anything else they know. And the right way to think about investing is to act thinking about your best opportunity cost.
Charlie Munger at the end sums it up quite nicely. You don't need to know everything. In fact, you should realize that you don't know everything. Then just focus on stuff you do know. If you've worked all your life in oil, then stick to oil as your expertise. If you are in real estate, then focus on real estate. It's perfectly fine if you miss out on the next Amazon or Google. Just focus on finding the right company in your field of expertise. Once you have that one company, you should be putting all your money into that company unless you can find other opportunities that can give better returns than the first one. Like Munger said, once you have a good company, now that becomes the measuring stick that you measure all your future potential investment against. This is something that goes against the common principle of diversification. So let me bring on my college friend Sam to explain why super investors recommend against diversification.
Ooh, first collaboration, and it's a controversial topic, but I'll be explaining the argument why the majority of successful investors hate diversification, including Buffett and Munger. Before someone goes down in the comments and points out that Buffett and Munger actually have hundreds of companies in their portfolio, let me explain. They are invested in so many companies because they have a lot of money. They have said jokingly that they would prefer to be invested in just one company that can take in hundreds of billions of dollars and generate a good return. Unfortunately, there is no such company in the world that you can buy at a fair price. Even if you do find a company that meets those requirements, it's very unlikely that that company will be able to produce spectacular returns for a long time. That's why Buffett and Munger are invested in so many companies. It's more of a need than a choice. But the main reason they recommend against diversification for retail investors is because of limited funds. I'm sure you realize that retail investors aren't flushed with cash. So, when you're limited by the amount of money you have, you want to make sure you get the most out of every last dollar. And opportunity cost becomes a big part of the decision-making process. That's why diversification doesn't really make sense. You're doing your research and you find 3 companies that you think are a good investment. But very rarely would all 3 companies be equally good. There's always one that has better potential than others. Now you have a choice. You have limited amount of money and you have 3 good companies. But it's not really a choice at all. You should actually invest all your money in your best conviction stock. Because any dollar that doesn't get invested in your first choice is a dollar that's underutilized. Hopefully that clarifies it, but I do want to finish off with one more point. This is not to say that you shouldn't diversify or that diversification is a bad thing in general. As with many things in life, it depends on your situation. You should realize when you clicked on this video that turning small amount of capital into millions of dollars is hard work. It's not impossible, but it's not a cakewalk either. If you're someone who's a full-time investor with good researching skills to evaluate stocks, you probably shouldn't diversify away from your high conviction stock. But if you're someone who has a good 9-to-5 job or a business, you just invest passively to save for retirement or some other goal, then diversification makes sense for you. You don't have time to research individual companies and then keep up with these companies on a quarterly basis. So diversification is a good way to hedge against your own ignorance. So hopefully that gives you guys some idea on both sides of the argument. Please do comment below if you have any question, and I'll try my best to reply to you.
Hopefully that was helpful. Be sure to check out his channel by clicking the card above or link in the description. Now let's get back to hearing from Buffett.
Hi, I'm Howard Winston from Cincinnati, Ohio. First, I wanted to thank you and Charlie for your sharing your time with us today.
Thank you.
My question is, you've repeatedly said that you see many wonderful stock ideas, but can't invest because they're too small. Given that many in the audience today have a lower dollar investment threshold...
Do these stocks have names?
Well said.
Well, the answer to that is that we don't look anymore. We assume that there are a reasonable number of opportunities as you work with smaller amounts of capital, because it's always been true. I mean, it was over the years, as I looked at things, clearly you run into companies that are less followed as you get smaller, and there's more chances for inefficiency when you're dealing with something where you can buy $100,000 worth of it in a month rather than 100 million. But that is not because I'm carrying around in my head the names of 25 companies that we could put 100,000 in. And I just don't look at that universe anymore. Sometimes people send me annual reports or get letters from managers, and they say, well, you know, I've got this wonderful thing, and I usually know ahead of time, but I mean, I would first look at the size, and if the size isn't right, and it isn't going to be virtually any time, I don't look any further, because there's just no time to be looking at all kinds of smaller opportunities. I do think if you're working with very small amounts of money that there almost always are some significant inefficiency someplace to find things that I've mentioned to some people. When I started out, I actually went through all of the Moody's manuals and the Standard & Poor's manuals page by page, and you know, it's probably 20,000 pages, but there were a lot of things that popped out, and none of them were in any brokerage report or anything of the sort. They were just plain overlooked, and you could find out about them, but nobody was going to tell you about them. And my guess is that continues to be true, but not on anything like the scale it was then. Charlie?
Well, I can remember when you bought one membership in some duck club that had oil under it when you were young.
Yeah, there was a company called Atlas.
When you get down to one duck club membership, well, you're really scavenging for cigar butts. But
not a bad cigar butt. There were 98 shares outstanding. It was the Delta Duck Club, and the Delta Duck Club was founded by 100 guys who put in $50 each, except two fellows didn't pay. So there were only 98 shares outstanding. They bought a piece of land down in Louisiana, and one time somebody shot downward instead of upward, and oil and gas started spewing forth out of the ground. So they renamed it Atlas, which is Delta spelled backwards, which was sort of illustrated the sophistication of this group. And a few years later, they were taking, at $3 a barrel oil, they were taking about $1 million a year in royalties out of the place, and the stock was selling at $29,000 a share, and it was earning $10,000 a share. No, it was earning about $7,000 a share after tax, about $11,000 pre-tax, and it had about $20,000 a share in cash, and it was a long-lived field. So, you know, I use that sometimes as an example of efficient markets, because somebody called me and offered me a share of it, and those things, you know, is that an efficient market or not? You know, $29,000 for $20,000 of cash plus $11,000 of royalty income at 25-cent gas and $3 oil. I don't think so. You can find things out there. I'll give you hunting rights on all my duck clubs in the future.